the current market right now is not only scary, but it also is really reminiscent of the kind of price action we've seen in 2008, where compulsions had taken over. Compulsions of algorithm trading, machine-based trading, and classic selling patterns in terms of price action are visible. So is this time now to participate in this market, or should one protect the capital? How should one decode risk versus volatility in this kind of a market, and to decode that, to understand that, and to talk about historically when markets have cracked like this, in hindsight, has that turned out to be a buying opportunity? I have with me market veteran Madhusudan Kela. Madhu, fantastic to have you on ET Now. Thank you for joining us. I'm not getting into why markets have fallen, but what people want to understand from you is that what is next?
Yeah, Nikunj, thank you so much for having me. So I would say, there are 2 points which I want to make in the beginning. One, this is the time to, maintain calm and think peacefully about investing, whether you are already an investor or you are thinking of allocating more equity, more capital, more allocation to equity. That is point number one. Point number two, I would say that this is a time when you have to use your past experiences as to, whenever market faced a situation like this, what happens 6 months, 12 months, 18 months, 24 months down the line is, we have always seen markets invariably repeat what has happened in the past. So, first point is that this is the volatility which is not to be seen in many years. At least I have not seen this kind of volatility for many years. When markets are locked down in a country like America, 7%, and then next day they go up 5%. Forget retail investor. I'm sure even institutional investors are getting very jittery about this kind of volatility. So my advice to all your viewers is maintain calm. If you are not an investor in equity, there could not be a better entry point. However, just make sure that you keep in mind that these markets are likely to remain volatile. The coronavirus situation, many people are arguing till the time it sets in, the temperature become warmer in these countries where the spread is happening, it may be possible that the situation may become even worse than what it is today over the next 25-30 days. But we have to use this volatility in this market. We have to use this volatility over this time frame to systematically invest. So I would argue that this is not the time to panic and just think of selling, but this is the time to systematically accumulate, provided you have the stomach to digest the volatility, and if you are a long-term investor.
Madhu, I know you are a big foodie, so I will talk in food terminology. If you eat a pizza, you get instant gratification. If you cook a dal makhani, you have to labor it out, but after some time the rewards are beneficial. So do you think this is time to start cooking the dal makhani and not chase the pizza for quick money?
I agree with you, Nikunj. This is a very brilliant analogy. This is not the time for pizza. This is not the time for looking at instant gratification, but it is a time wherein you will, you will have to cook it properly, you will have to digest it properly and eat it over a period of time.
Okay. Madhu, we don't know the medical news. China is saying the virus is getting contained. Italy is saying the virus is spreading. So we don't know. So let's not get into what we don't know. But what we know that historically when markets have corrected like this, they always tend to bottom out in terms of the P multiple. So in terms of your analysis and your observation, fundamentally how far are we away from a bottom?
So that's what I'm trying to say, Nikunj. In this kind of markets, it's very tough to call that this is the bottom, or bottom is 5% lower, or we have already seen the bottom, or bottom is 10% lower. That I don't think anyone can predict. And this kind of markets where ETFs are predominant players and not the people who are rationally thinking about stocks. So, you know, an ETF decides that I want to sell $1 billion. They don't look at the prices, they just want an exit. And that is, I think, what we have seen the behavior of the market in the last 5-7 days, worldwide as well as in India. It is clearly driven by that kind of a selling. So in these markets, to even try to predict that we are in the bottom or we are near to bottom will not yield results. What will definitely yield results is, let's say, you know, now look at India specific. What is happening in the world is, so India specific, the coronavirus impact is very, very limited. And I would go to an extent of saying maybe it is our diet, maybe it is our resistance, or maybe it is our temperature. Otherwise, it is very, very hard to believe that we have 130 crore people, and for whatever reason, under God's grace, the virus is not affected India as much as it has affected worldwide. So let us say that is a base case. If that is a base case, then whatever is happening internationally, and I want to spend 2 minutes here, you know, this the fall in oil prices is not a small thing. And I would say that, you know, the fall should not, it will not be knee-jerk. So I don't expect that, you know, even tomorrow, let's say if OPEC comes up and says that we have some kind of an arrangement, I don't expect the prices to go up again from $35 to $70, because you have had a slowdown in the global GDP, because you have had an impact in the oil demand. So oil prices are likely to remain here at least in the near future of next 6-9 months. I would not say it is $35, but certainly not going to $70. So that brings in a lot of good news for India. It helps the first fiscal situation of the government. Also, it helps a lot of sectors, you know. And third, Nikunj, again the most important thing, we've been talking about this earning growth coming in for last 7-8 years. In the beginning of year, every analyst, every fund manager is expecting that this year we are going to see a 20% earning growth. And by the time we end the year, we end up with 3%, 5%. I think because we will have a lower base in 2020, lot of upfronting in banks in terms of provision is being made, and then you have the impact of lower crude oil prices. So next year, actually earnings will positively will have the potential to positively surprise the market. And when we have seen, whenever the earning will come, markets will have to respect it. So I am fairly optimistic that you will see in 2021 a decent earning growth, which we have not seen in the last so many years.
Madhu, I had Prashant Jain of HDFC Mutual Fund last week, and he is of the view that with each crisis, the market leadership changes, which is that in 2000, when market corrected, infrastructure made a comeback. When infrastructure stocks corrected, consumer stocks made a comeback. Do you think with this crisis, the leadership in the market will also change? Because this is the point you've been making again and again every time we've met, which is get out of quality. Do you see it happening now finally?
It is very much possible, Nikunj, you know, because in this kind of environment, it will really need guts for someone to hold a stock at 60-70 PE multiple, specifically if I don't see a 10-15% earning growth also in these companies. So it is very much possible that the new players, specifically deep value stocks, may make comeback in this market. It's very possible. Because let's not forget that, you know, people have forgotten spellings of a lot of these companies, and these are companies which are available at 3, 4, 5 P multiple. The ownership levels have diminished meaningfully. So if you look at any of these deep value companies, there's hardly any institutional investor left in a lot of these companies. So, you know, whenever, if the fashion changes, or if the fashion comes in their favor, it will need very small buying for these stocks to rise meaningfully.
Madhu, the way how government has smartly handled the Yes Bank saga, do you think markets are not appreciating, and given the global turmoil, this good work is getting lost?
Now, I don't think, Nikunj, it will get lost. Markets definitely are aware that the government has done a brilliant job of handling this crisis, that, we have never seen a response like this, which came in so quickly after they diagnosed that this needs to be sorted out. But what is happening globally, you can't say that our markets will be unaffected if Dow is hitting a lower circuit. So I think it's a matter of time before market will recognize that the government has done a good job in handling this crisis.
So Madhu, I'm breaking the market into three parts. One, sentiment, which according to you right now is completely bearish. We've got capitulated. And historically, according to your analysis, when sentiment becomes that bad, it's time to buy. Let's focus on the second aspect, which is liquidity, Madhu. We are still dependent on global flows. One day of FI selling and look what happened on Monday. 1 week of FI selling and look at what's happened to market in last 1 week. Given that there is pressure at global level because the Dow has come down, machine-based programming has taken over, what happens if $3, $4, $5 billion gets out from India via the FI route?
Which is why that's the precise point I'm making, Nikunj. That is very, very hard to predict. And what you are saying, it is very likely that some more foreign selling can come in. And which is the point which I am saying, that whatever amount of money which you need to invest, you don't possibly need to do it in one day. You stagger it over a period of, let's say, whatever time which you want to choose. You stagger it over a period of time and do systematic investment, rather than saying that this is the time, this is the bottom of the market and I would buy everything which I need to buy tomorrow morning.
Madhu, over the years I've interacted with you, what I've always learned and appreciated about your investment approach is that you always focus on not where the puck has moved, but where the puck would move. Now that global supply chains have got disturbed, the dependence on China will also reduce. How will this translate into great opportunity for Indian pharma, Indian manufacturing and other Indian companies?
So I think, Nikunj, if you are let's say, if you are a company which is looking to outsource these goods from any country, whether it is India or China, and right now if your dependence on China was 90% or 100% of this material you are sourcing because it was available cheap, I am very sure after this event and a lot of events which have happened, and I very, very closely track the pharmaceutical sector, wherein there was a incident of pollution in China 2 years back. Then, these certain drugs which were imported, the intermediaries were found to be having some cancerous inputs in that. And then now you have coronavirus. So in medium term, if you are a global outsourcing guy, you would think that, okay, even if I have to pay 10-20% higher, I would better off diversifying my source of supply. So to that extent, in medium term, the Indian companies will definitely benefit. And I've been very closely interacting with a lot of pharma companies and a lot of companies which will benefit. A lot of people are already saying that they are seeing increased inquiries on account of all of this. That also may be a knee-jerk because China's supplies were closed down for a month or so. But in my view, it will certainly benefit Indian manufacturing, specifically the pharma companies in medium term, as a second source of supplier, India being a second preferred source of supplier for all of this.
So Madhu, let's address all the concerns which haunted us locally. I'm keeping coronavirus aside, I'm keeping global liquidity issue aside, I'm keeping FI selling aside. We don't know how things would move there. But let's look at local issue. Yes Bank, NBFC crisis, AGR issue and resolution on that front. Gradually, you think all the local issues are getting sorted?
And they are getting sorted out. And what your own newspaper reported that this AGR issue may also get sorted out soon. I just read it in Times of India, and I would say that those were the two major issues. The NBFC crisis was majorly being factored into the prices, and that is only getting better. I think we are much better off than we were 3 months back. And also this overall bad debt situation, Nikunj, which we have been seeing for last so many years. Maybe a lot of worst has happened and maybe priced in. You can never make a comment that 100% of that is being provided for or discounted for. If the economic situation worldwide really deteriorates a lot, then that issue might still prop up. But a lot of these issues are getting over as far as domestic concerns are concerned.
Madhu, we've also seen a sizable correction in small banks. Bandhan Bank, RBL, markets are getting nervous that just because there's problem with a private bank, every other private bank will suffer. Now it's not going to happen like that, we both know that. So secretly, are you eyeing that space? New private sector banks, small private sector banks, they've been beaten black and blue, 30, 40, 50% is the average correction.
Nikunj, this is like a buffet. You have to eat as much as you can digest. And there is value everywhere. There is value in so many companies, so many quality companies which are not to be seen in the last so many years. You just have to look through proper lenses. On financials, the only point which I will mention that the weightage of financials in the overall Nifty, the free float weightage is still, I calculated as of yesterday, is still 41%. So there is a tremendous overweight of funds when they are investing into India on a free float basis. So that's one thing which you have to keep in mind when you are looking at a financial stock. Having said that, there will be individual gainers and some money will shift from stock A to stock B. And if there is a disproportionate value which is there in financial stock also in the private sector space, I would definitely look at it. But you have to keep this over ownership in mind. So just as a comparison, the weightage of financial is 41% and the weightage of pharma is 2%.
Thank you for highlighting that. So Madhu, let's talk about IT and consumers. Companies which generate a lot of cash and companies which don't have any leverage or debt issues. Historically, when crises have happened, money has always flocked to companies which don't have debt, which generate a lot of cash and which have high return ratios. So what will happen to these two groups?
So IT companies, at least in the short term, I would argue might be getting impacted with this overall global situation, and we will have to still see how this overall global situation develops, Nikunj. How long does this virus scare go, and where does that stabilize, and to what extent there is a slowdown in the global economy, and subsequently that impacting demand for IT services. So we will have to still see that. Having said that, the rupee depreciation definitely benefits them. So, but I know at this point of time, as an individual investor, am I looking at IT stocks? The answer is no.
Apart from pharma, what exactly is Madhu Kela, the individual investor, looking at?
So Nikunj, I think you can see a lot of value. Trust me, I don't even need to speak out the names. If you do your homework properly, there are so many good quality companies available at historically low valuation. Now, some of them are in the public sector domain, some of them are in the media domain, some of them are in the pharma domain, some of them are in the OMC domain. So I would say that at this point of time, you just have to do your work properly on these companies on a bottom-up basis. There are plenty of opportunities which are available. I will repeat, even though it is mouth-watering to say that it is available so cheap, let me just go and buy. But you still have to give it time and only do systematic investment, because you never know, as you rightly said, can I rule out that there will not be a $1-2 billion more selling if the situation deteriorates globally? It is entirely possible. So you will have to use your ammunition very properly, and you will have to do systematic investment rather than doing it at one go just because the stocks are available cheap. Because cheap can always become more cheaper and expensive can always become more expensive. These are the lessons which we have learned over the last 30 years. So bottom line, time to look at stocks selectively, time to invest, going by the past experience and going by what one has learned in the past, but be systematic, have the stomach to digest the volatility, and invest with a time frame of 3 to 5 years. And I'm sure this will prove to be a good time to do this.
So, Madhu, I'm asking very basic question just for the benefit of our viewers. In 2008, there was a crisis of the system. This is a crisis within the system. But the selling is reminiscent of what we saw in 2008. So, if the system is not going to fall apart, why are financial markets panicking as if this is end of the world?
One, markets worldwide had done exceedingly well in the last 2 years. So that needed an excuse, to fall. That we have always seen again in the past that, a coronavirus may have come as an excuse for the fall. But because we were sitting at such handsome gain and markets had done so well internationally and everyone's position was on the buy side, there were hardly any bears left in the last 2 years. So that is one reason. And second, of course, this ETF driven selling which happens, which I've been saying that it doesn't look at the fundamental in the short term. If I have to sell, I have to sell. And that is those are the reasons which can explain this kind of fall in the market. And it is right now it has not got to do with any financial stability. However, market may also be worried that if this situation continues for a 1 or 2 quarters, then that may result into some kind of financial stability, and people who are taking that call may be taking some money off the table.
Madhu, we have never seen US bond yields fall to levels of 0.5% or 0.74%. That is the biggest instrument in the world. If the biggest instrument in the world is trading at levels which it has not traded, it means a reboot for everybody. How should one read into that?
So in the short term, Nikunj, if you want to just park your money and if you want to park billions of dollars, that is the real only instrument which is available. So in the short term, whenever there is this kind of risk aversion happens, and there are not everyone is thinking about the market the way I am thinking. There are people who may be making a case that this whole situation will become very worse. The global GDP will go, the global economy may go into recession. There are all kinds of people who are thinking even that. Today only I saw a survey wherein 53% people are saying that the US economy may go to recession. So if you have that view and if you are a large institutional investor, the only real instrument which is left for your safety is the US Treasury, which that explains why the yields have fallen so low.
Market men are making an argument that it's time to buy PSUs. They are available cheap. They have strong dividend yield. In this market, you should hunt for companies which have a strong dividend yield. Would you agree with that? Do you think classic old-time investing will make a comeback when you look at the value of a land, cement, dividend yield?
I think there is too much deep value out there. So I would certainly agree that selectively that pocket is really throwing opportunities, and one should look at it, because the market cap of a lot of these companies have really fallen, Nikunj, specifically in the last 6 months. And again, going by my past experience, I have seen whenever the fall accelerates and you have seen a capitulation of this nature, it has invariably proven a right time to buy, because these companies used to fall like 5-10% in a year. Now you are seeing a drop of 50 to 60% in the last 1 year in a lot of these companies. So this is clear sign of capitulation. And let's mind you that this is not accompanied by a fall in earnings. By a lot of these companies may see actually revision upward in their profits, but stock prices are falling the way they are falling. So there is a very strong case of looking at the PSU basket very selectively.
Sounding slightly repetitive with this one, but Madhu, today we are doing a discussion at a time when the world is in a chaos. So I want to get your message loud and clear. You are of the view that for those who can digest a 20% downside, maybe a 20% volatility, this is more like a blessing in disguise and one should be buying. मतलब in हिंदी में बोले तो छप्पर फाड़ के लेना चाहिए.
मैं छप्पर फाड़ के तो नहीं बोलूँगा निकुंज, पर मैं ज़रूर ये बोलूँगा कि आपने बोला ना कि अगर आप वॉलेटिलिटी को डाइजेस्ट कर सकते हो एंड अगर आपका होराइजन 3 से 5 साल है इन्वेस्टिंग में, तो ये डेफिनेटली अच्छा टाइम है स्टॉक्स लेने का.
All right, I was looking for that answer, Madhu. Thank you for joining us. I know on a morning when everybody is glued to the screen, we got you glued. Our viewers are glued to the 18 hour screen because you are talking. So really appreciate your time and thank you for talking to us.
That's the big takeaway from Madhu Kela this morning.